Hi, my name's Steve Walker from Promise Money, and today I'm talking about commercial investment properties, raising mortgages, but specifically if you have an investment property, I'm talking about affordability and how different lenders look at affordability and the impact that can make to you. Very often people come to us and they'll say, look, I want the maximum amount I can get at the cheapest rate. And getting that maximum amount and that cheapest rate is going to depend partly on affordability as well as a number of factors. So it's important that we get that right. And if I tell you what you need to do to get it right, that might help you, I guess, prepare. So yeah, with rates rising at the moment, affordability is becoming more of a factor. So I'll come on to that in a moment. But the key things outside affordability are, right, LTV. You want the maximum LTV, but what's the property type? That can affect. Some lenders don't like certain property types. What's the length of the lease? If you're looking to get the best terms, the longer the lease, the better, within reason, as long as it's not so long and with no breaks that actually that devalues it because they can never get vacant possession. So, but the length of the lease, ideally, if you're going for a loan which has got a 5-year term on it or a 5-year fixed term, the lenders are going to be thinking, well, if the lease at least covers for those 5 years, that's ideal. So that opens the door to certain lenders. And if you didn't have a lease if you only had a lease for a year, some lenders will say, no, that's not long enough for us. So length of the lease, important. Location, where is it located? Not only which part of the country, but where is it within a certain town. The loan amount has an effect as well, because there are some lenders who don't start until £250,000, or others that don't start until £500,000. So if it's a smaller amount, you might find there are certain lenders that say, well, we're not in the game for that. And then we've got to then look at whether we're going to a high street lender or we're going to a specialist lender. So all of these factors come into play, and we have to take that into consideration before we even get into the affordability side of things. Other things that you might want to think about is who's the tenant. What type of business are they in? How long have they been established? If it's a new tenant going in with a new business, one of the lenders who's going to offer you maybe the best terms is going to look at that tenant and say, well, we're a bit nervous about this because you've got a lovely building, but the tenant isn't established. They could go bump at any time. Where does that leave us? So they might just say, not one for us. And another factor is the type of income that you have. And an example of that would be, you might have a property which has got a tenant in it, but you've got a couple of radio masts on the roof, and they're bringing in £10,000 a year each, and you'll think, great, I can use that. Well, some lenders won't use it, some will. So again, the type of income. Another factor to think about is whether or not the property is an opco-propco. That means you've got a business which owns the property and another business that lets it out. Normally you see opco-propco in a owner-occupier scenario. Somebody owns the business personally and lets it to his own company. So that's a factor as well, because some lenders handle opco-propco well, some don't. Another factor is the lender's policy. Some lenders will go on the rental income. Some will automatically, every time, say we're going to knock 10% off for costs, because we're going to assume that you've got costs with regards to achieving that rental income. Some will, some won't. Some will knock off more. So for each different lender, we've got to arrive at what's the net usable rent, take into consideration the parts that they don't like, the rents that they don't like the masts, or there might be a garage on the side, or there might be a car park. We let the car park. So, well, and we don't do car parks, so we're going to ignore that part of the rent, but we will use the rest. So get to the net rentable income. So we've established what rent we've got. We've established those lenders that will use that rent or won't use that rent. We know who we've got to play with. We know what the property is. We know where it is. We've got an idea of all the lenders that are available. Another factor that, especially if you're in the buy-to-let game, you might be used to top slicing. This is where a lender will allow you to use some outside income to support the borrowing. With most commercial investment lenders, they don't do that. They say the asset must support itself. The property's got to be generating enough rent, taking into consideration all of the calculations we do to support the loan. That doesn't mean there aren't lenders that will allow top slicing, but they are few and far between. They are going to cost you more. So ideally, it needs to stack up on the rent, and it needs to be the rent from that particular property, not from another property. One of the things just to bear in mind is if you're over renting, and what I mean by that is you let's say you're getting a rent of £50,000 per annum, but the valuer says, well, you've struck lucky there, we think it's worth £40,000 per annum. Chances are the lender's going to go on the lower of the passing rent and what the valuer says. So if the valuer says it's worth 40, that's the rental income that you're going to use. So be aware of that. If you think you're onto a great deal, the valuer might not agree with you, knock the rent down, and that's the figure we'll have to work on. So again, that's something to consider in your numbers. Right, so let's move on. So getting right into the affordability part now, let's say you've got a rent of £50,000 per annum. The factors that the lenders are going to consider are as follows. Firstly, the interest rate. If they are a lender that offers you a lower interest rate, then the loan's naturally going to be more affordable than if it was a higher interest rate. So we find very often at the moment, because rates have gone up, that people say, I want to borrow to 75% of the value of the property, which is, that's generally where you can get to on an investment property. Not all lenders go that high, but that's where you can get to. But because of the affordability and the rent that's coming from that property, we can't get enough income to support a loan that big because it's not affordable. So the lender's interest rate is critical to that, because to give you an example, if you've got a lender at 5.5% and you've got another lender at 7.5%, then that loan's going to cost you more. Therefore, if it doesn't stack up on affordability, you'll have to borrow less to make it stack up. The next factor is the stress rate. Now, in most cases, lenders will have a stress rate which is different to the pay rate. So they might say to you, we'll give you a deal at 2.5% plus base, and when you watch this video, who knows what base rates will be, but let's say that's 6%. We'll give you a deal at 6%, but we're going to make some assumptions here that rates are going to increase. We're going to cover our back. So whilst you're paying 6%, we're going to stress it at 8.5%. So we're going to make sure that you can afford the repayments if it went up to 8.5%. So they apply a stress rate to their calculation. That's the first thing. The second thing that they'll tend to do is they'll apply a debt service coverage ratio. Now, high street lenders, they're at 175% to 200% debt service coverage ratio. And I'll give you some numbers to explain that in a moment. But the debt service coverage ratio is how much, if the monthly repayment is £1,000 a month, and they've got a debt service coverage ratio of 200%, they want to see that you've got a rent of £2,000 a month. So it's a buffer. They're building a buffer in. Now, normally you're looking at, for specialist lenders, around about 125%. So if you've got £1,000 a month, they're going to say, right, you need to have £1,250 a month rent to cover the stress payment of £1,000 a month. Bear in mind, the stress payment is higher than you're actually paying. You might only be paying £750 a month. £750 a month, stress is up to 1,000, debt service coverage, we want to see 1,250. And 1,250 is on the low side. If you're going to high street lenders, it could easily be 1,750 that they would want to see. So in your mind, you're thinking, hang on, I'm getting a rent of £750 a month, and you're telling me I need £1,750 to be able to afford this loan. Yeah, that's what they're telling you. Fortunately, or unfortunately, most high street lenders aren't really in the investment game. They're more interested in owner-occupied businesses, but they will do certain assets, but generally speaking, it's not their game. Another factor is whether the loan is capital and repayment or capital and interest, i.e. you're paying it over a 25-year term and reducing the balance by paying interest each month, or interest only. Because an interest only payment, if the rate was the same, an interest only repayment is going to be far less than a cap and repayment loan, because you're not paying off the interest each month. So a lot of the lenders will offer interest only, but they will work out affordability on a capital repayment basis. So again, they're covering worst case scenario. Then, as I mentioned earlier, we've got deductions for costs. Some lenders will say, right, if your rent's 50 grand, we are not 10% off straight away, so we'll work on 45. Others will say, no, we'll work on 50. And then what are the elements that they won't allow? Again, you've got some telephone masts. No, we won't allow that. We've got a short lease. No, we won't allow that. You could have a property which has got multiple tenants in it, and they'll say, well, we'll take those, we'll take that income, but we won't take that one. I've got one lender that doesn't like people who are car dealers, and they say, well, only 20% of the rent can come from a business which is a car dealer. So if you've got your car dealer is using 30% is 30% of your rent, so we'll only take 20% of it. That's another factor. Semi-commercial, some lenders look at semi-commercial and they'll use both the residential and the commercial rent. Some will say, well, we'll do semi-commercial, but we're only going to rely on the residential because really we want to do residentials. We'll just accept the fact that there's a commercial element to it. So as underwriters, we've got to factor all this into our thought process to work out where we're going to go. So now let's just talk through now some examples of some stressed rates and debt service coverage variations, so you can see the difference it could make. So let's take a £50,000 rent, and let's say that's the net rent. We won't worry about the cost. This is just for comparison purposes. If we go into a high street type lender where we've got £50,000 worth of allowable rent, taking everything else into consideration I've just talked about, and we're doing 175% debt service coverage, that means that £50,000, we've only got £28,500 to play with. That's because that 28,500, multiply that by 175%, gets the rent that they will allow, that works for them. So your stressed repayments can't be more than £28,000. That's about £2,370 a month. Okay. They then apply their stressed rate of 8.5% to it over a 25-year term and say, right, it's capital interest over 25 years. We're going to apply a stress rate of 8.5%. That's going to get you to about a £300,000 loan with your £50,000 worth of rent with a high street type lender. Okay, I'm now going to go to the opposite end of the spectrum just to show you the difference. We've got a specialist lender who will take that £50,000, could be the net figure again. They don't stress at 175, they stress at 125. Debt service coverage at 125%. So that means instead of it being £28,000 income that they will use in their calculation, it's 40,000, i.e. 40,000 times 125 gets you to 50,000. So that's about £3,300 a month. That's £1,000 more per month we've got to use to support the borrowing to get you the amount that you want. So obviously there's a chance we're going to get more. Secondly, they don't stress at 8.5. If it's a fixed rate deal, they stress at pay rate, and at the moment probably around about 5.6%. Again, whenever you watch this video, that will have changed. So at 5.6%, which is a lower rate and a lower debt service coverage and they'll still do capital interest over a 25-year term, instead of that being a £300,000 loan, that's a £525,000 loan. Now that difference is massive. Yeah. So what we want to be trying to do, because it's a good rate too, this lender's offering some great rates, we want to get you onto that really low 5.6 rate. Take advantage of the fact that that's what they work on for their stressed rate too. Take advantage of the fact that they only have a debt service coverage of 125%, means we can raise you much more money. So I guess a lot of this, the reason I'm telling you these things is it helps you think about how you prepare yourself to be able to qualify for that loan rather than another loan. For example, we might there might be a lender where the type of property doesn't tick their box, or the length of the leases doesn't tick their box, or something like that, and we're then looking at different lenders. We say, right, how are we going to get the amount that you want? And that could be when we then look at an interest only loan. Because it's interest only and not capital repayment, you're not paying the interest back, which means that the repayments on a like for like basis, i.e. the same rate, are always going to be less. However, it might not be as low as 5.6 because that's a really good rate. So we might find we're going to a slightly higher rate on an interest only basis, but we're still able to get you more all the same. Example of that, semi-commercial property, current rate with the lender I'm thinking of, 6.9%. Okay, they will stress at 6.9%. They've got 125% debt service coverage, which means we've again got about £3,000 a month, but it's on interest only, so the repayments are lower. So we can probably get to around about a similar number, £550,000 on an interest only basis. So we can still get there, 75% loan to value, £575,000. We've done it on interest only because it didn't fit the criteria for the other lender. So that can work as well. Fully commercial, the rates are higher, a little bit higher, so you're probably only going to get to about 500,000. Key point here is preparation, knowing your lenders, getting everything set up properly, having decent leases, and we can raise more money and potentially get lower rates. So let me just give you a few tips on things to think about so that you can take advantage of this work that we have to do behind the scenes to get the best deal that you possibly can when it comes to either buying a commercial or semi-commercial premises or remortgaging. So a few tips before you start, and you're not going to tick all these boxes. If you do, that's great, but you probably won't. So first of all, if you're buying a property or you already own a property, sometimes you have tenants on holdover, their leases have expired. Not great. Some lenders will say not really interested. That can make quite a bit of difference because some lenders will ignore that rental income. Now, if you're not trying to push the max to get to the highest loan amount, it probably doesn't matter. But if you're looking to get as much out of it as you possibly can at the best deal, then really you don't really want tenants on holdover. Leases, if you can have leases of 5 years plus to run at the time, still to run at the time you go for finance, that is better. That is going to give you more options. That's going to be attractive to the lenders who will go to not necessarily better LTVs, but offer better terms, better rates. Have you got EPCs in place? If you're buying somewhere, has it got an EPC? Because potentially you can buy a property which hasn't got a tenant on the basis that you're going to have a lease in place for completion. Okay, so think about that scenario where I've seen a property, that's great. Nobody's going to lend on an empty property because it's got no income. Well, I say nobody. If you've got income elsewhere, then we can use that. But then you go into lenders who are using external income. It's a whole different ball game. It gets expensive. So what's going through your mind is, right, I've seen a property, I'm going to buy it, and I'm going to put a tenant in place. And you've got that tenant all lined up. Lenders will do that. Some lenders will do that, but they'll want to see that lease in place and signed for completion, so they know that that tenant's going to go in. The reason I say EPCs are important is because if you haven't got an EPC, potentially that could give you some problems because they're going to say, can we see your EPC? And the other thing to think about is planning. If you've seen a property and the planning doesn't match what the tenant is going to do within that property, then when it gets to legal completion, the solicitors are going to just throw up a red flag and say, actually, you don't have consent to put that tenant in there, even though you might think it's fine. So look at the planning. Semi-commercial, if you're a general investor and you're thinking, where am I going to go? Well, I'll just say to you, semi-commercial, generally you're going to get better rates than fully commercial and investment properties. So look at semi-commercial and make sure you've got an AST in place for the residential element and a decent lease for the commercial element. Loan amounts, that's another factor. We've got lenders who will say, really, we want to be doing £400,000 plus. I've got a really good lender who starts at 250. So, you know, if you're buying, if their loan is 250 and they'll go to 75% loan to value, you need to be looking at properties which are 300 and something plus. So 250 is a magic number. 125 is another magic number. There's a lender where their minimum is 125. Under £125,000, the lenders that used to be quite prevalent in that area, they pulled out of the market and increased their loan amounts massively. So there's not that much choice once you're under 125,000. 250 is great. Under 125,000, yes, there are lenders that will do investment property, but there aren't so many. So just be aware of that because that affects price. Make sure you've got your deposit. Think about the deposit you need. Don't forget stamp duty, don't forget legals if you've got enough cash for that. Be aware that if you've got assets outside of the property you're looking to buy, you might be able to raise deposits on that, but that's probably a separate loan. Purpose of the loan is important as well. If it's investment property, some lenders, again the ones who are the cheapest and the fussiest, they'll want to know what you're going to spend the money on and want to see that that's reasonable. So if you're thinking of, say, I want it for my daughter's wedding or to go on holiday, well, that's not a commercial use. So some lenders might say, well, we're not too keen on that. So most often people are raising money on their existing properties to go and buy another one. So that's fine. And the other thing to bear in mind, and this is really important, is if you are taking all of that rent out to live on, okay, and you haven't got any other income at all, then when the lender looks at the application, they're going to say, right, well, you've got this rent, and I was talking about £50,000 earlier on, but you're taking all of that out to live on. Therefore, if they use that rent to support the borrowing, then you've got nothing to live on. And therefore, they're going to say, well, what happens if there's a void, and how are you going to live? So they do that. In most cases, they're going to do that plausibility test to make sure that you've got enough external income. Now, if you own this property but you've got your own business elsewhere and you're earning off that, or your partner at home, your spouse has got a really good job and they're paying for all the household expenses, then that's fine. We'd say, okay, well, your living costs are all covered, so we can use the rent. But if you're spending every penny of the rent to live, that is going to be an issue. So bear that in mind as well. A lot there. I hope it's given you a little bit of a steer. I hope it's been helpful. If it has been, please like the video. Please subscribe to our channel if you're not already subscribed, because there's lots more of this sort of stuff coming out. And check us out. Check everything we do on YouTube. There's a whole load of different playlists there about buy-to-let, about residential, about secured loans, about development, about bridging. And you'll find that on YouTube, Promise Money. And go to our website, promisemoney.co.uk. I hope that's helpful. Talk to you soon. Bye-bye.